Hello and welcome to BloxLive TV. Today is Thursday, February the 14th. We're now live with the latest in the crypto world. It's 9:30 a.m. in New York City, 2:30 p.m. in London, 11:30 p.m. in Tokyo and 3:30 p.m. here in Malta. While the total market capitalization has declined by slightly more than $1 billion to approach the $120 billion support line. Let's take a closer look in today's Crypto Now live show. The cryptocurrency index CCI 30 is nearly unchanged from yesterday as it stands approximately 50 points above the $2,000 level. The 30-day Bitcoin volatility index plummeted once again on Wednesday and it now stands just slightly above the 2% level, where it was last seen prior to the November market crash. The 24-hour traded volume indicator suddenly jumped by nearly 100% to surge above the 36 billion level. It stood around this level for more than an hour before retreating back to the previous $20 billion territory. Well, this appears to have had no immediate influence on the market. The Bitcoin dominance indicator has remained below the 53% level as markets have been generally trading sideways. Litecoin is once again the fourth cryptocurrency by market capitalization, pushing EOS to the fifth spot. Bitcoin is showing stability as it trades almost unchanged at slightly more than $3,600. Ether holds its ground above the $120 level and Ripple's XRP trades at more than 30 cents. Litecoin has posted a correction, but EOS declined even more to give up just over 4%. The coin 360 heat map shows a generally bearish picture, but most of the top asset declines are not significant. According to the Token Spread website, the biggest buy and sell side difference for the Bitcoin dollar pair is on the XMO exchange at slightly more than 0.4%. The Bitstamp and XMO exchanges have the biggest intermarket difference of more than 3%. Well, today is Valentine's Day and we'll take a look at some of the characteristics of what could potentially be the cutest cryptocurrency, the Dogecoin. It started as a joke in 2013 when it launched on the page The Popular Doge Meme by Winnie Marcus and Jackson Palmer. The coin was a fork of Lucky Coin, which turned out to be a fork of Litecoin. The asset was creating with a large circulating supply to keep the price down. This makes it useful as an online tipping tool. The Dogecoin community is known for its friendliness and fundraisers. One of the most famous projects was funding for the Jamaican bobsleigh team that qualified for the Sochi Winter Olympics, but could not afford the travel costs to Russia. Today, more than 500 Dogecoins can be purchased for just $1, making it a cheap and impressive gift on this Valentine's Day. We'll now assess the performance of the digital assets based on their use case categories that have been identified by the Masari website. The infrastructure group is having a generally bearish session, and it's more than 1% in the negative territory. The media and entertainment category posts a slight increase as it gets a bullish boost from the Theta token. The financial sector is down by less than 1% as assets show mixed performance. The currency category is close to 1% in the red as all of the major cryptocurrencies are trading lower. And lastly, the services section is down by more than 2 categories. That's slightly in the green on this bearish day. Well, this is where the 5 major cryptocurrency categories stand so far on this Tuesday. We'll now focus on the biggest moves among the top 100 cryptocurrencies to identify the top gainers and the biggest decliners. The majority of the assets are trading in the red, but there are some solid increases. The repo token was the most bearish asset yesterday, but it has bounced back by 21% to post the day's biggest rise. Trading is relatively light and the daily traded volume measures at less than $80,000. The Komodo coin has gained nearly 40% over the past week as it trades above the 85-cent mark. The Theta token is up by double digits on the move towards the 10-cent level as the asset continues its recent bullish performance. The Zem coin is up by 6% as it broke through the 4-cent level. The virtual coin was on a slide during the first week of February. The Loopring token surged last week and has jumped once again. Now, there are no significant drops on this generally bearish day. The coin of Mother of All Chains has been dominating the gainers section this week, but it's now time for a correction to its price, which is down by 5%. The Versatanium token is down for the second day in a row after rising above the $19 level earlier this week. The neocoin is down by 4% to retreat towards the $8 level after a bullish run. The Hypercash coin has been moving lower after hitting the high of $1.30 on Sunday. And the Nexo token is down by nearly 4% to test the 6-cent support level. Well, these are the top 24-hour moves during the European morning trading session on this Thursday. We're now joined by our crypto experts, Jason Fernandes, CEO and co-founder of A Token, and Kevin Mirko, CEO of Coin Metro, to discuss the latest in the markets. Hi, Jason, Kevin, how are you both today?
Hi, Jessica. Thank you for having me.
Great to have you both back. So we have seen today that markets have been relatively calm over the past 24 hours. Kevin, I want to start with you. Have we seen any interesting developments over the last 24 hours?
One thing that actually came across my desk, which I thought was quite interesting from both a fundamental and I guess just based on news that had, let's say, history, is JP Morgan. So one of the most vocal critics of Bitcoin, probably 2017, 2018, JP Diamond, so the guy who runs JP Morgan, basically saying that cryptocurrencies were a scam, that they had no future, et cetera, et cetera, et cetera, and always focusing on the fact that blockchain, however, was an interesting concept or an interesting technology. Announced today the JPM coin, which basically will be used, I guess, as something like a competitor to SWIFT. So they'll use it to transact some international payments, a very small percentage, they say initially, to test out the technology. So they actually made an announcement, I think, sometime late 2017 about a consortium, a group of banks, I think 70 different banks that were working together to create technology to basically go against SWIFT and reduce costs and just increase the, let's say, the overall, I guess, increase the ability for them to make payments, not only low cost payments, but also quicker payments across borders. So it's kind of interesting that they made the announcement. I do think that it shows that we're probably going to see more segmentation in the market overall before we start to see, let's say, lots of mergers and acquisitions, because we're going to start to see industries kind of make their own tech. So banking needs tech. Instead of looking at any existing tech, they're building their own. Logistics are doing the same thing. Many different larger industries are looking to build their own tech. So, but I do think it's interesting that one of the biggest Bitcoin bullies, let's say from 2017, now has his own cryptocurrency. So interesting news day, I think.
Definitely interesting developments. Now, Jason, I would like to turn to you because markets have been relatively calm over the past 24 hours. We did see a sharp increase in the CoinMarketCap website traded volume indicator this morning. What could be some of the reasons for this sudden surge? Is this a sign that is not such a reliable indicator?
I think part of the reason could be really a lot of increased trading that we're seeing from Venezuela. So Venezuela has seen record volumes over the past 24 hours and even prior to that. And part of the reason is because of Venezuela passing some crypto legislation. There has been some, since you pointed out about whether CoinMarketCap is a reliable indicator, there has been some criticism. Like last year, there was a report that came out that says BTC and ETH's volume was almost 80% fake, whereas XRP and Bitcoin Cash were something like 43% and 70%. In fact, that same report said that most other coins in the top 20 market cap have fake volume between 40% and 90%, which is obviously really massive. And part of the reason for this is due to the way CoinMarketCap pulls its data from the exchanges, and the problem is further exacerbated by the way these platforms record trading activity. So there's quite a large variation. There's actually a website called Honest CoinMarketCap. So there's quite a bit of variation between how different exchanges are reporting their trading activity. So there has been some criticism about it perhaps not being a really reliable indicator. But overall, I would say that it certainly seems like volume is picking up.
Volume is picking up, but markets have also been calm. So Jason, I'll stick with you and then we'll go to Kevin. Why do we think the markets have been so relatively calm in the past few days? Is this an indication of things moving in either direction in a significant way?
Price. So generally, if price falls along with volume, it generally marks a point of exhaustion, signaling a reversal is due to happen soon. On the other hand, higher price and lower volume usually lead to a drop in price. So because a rise in price with a drop in total volume would represent a stronger case for bears, because they would drag prices toward a lower bid, usually meeting a key resistance zone. But I think volume is a really good indicator, along with price, of where the market is moving.
Interesting. And Kevin, what do you think about this, about the fact that the markets have been so calm, and what we take this as an indication?
Yeah, I think Jason hit the nail on the head for the most part. I think just to go back to the question before about just the coin market cap data, and Jason made a comment, I mean, right now there's really no, let's say, requirements for any data that gets pushed to coin market cap. So data can be easily manipulated in a market that's controlled generally by many different segmented players, right? So, and we do have wash trading as well. That's quite a wash, I guess, inside the industry. Wash trading, for those who don't know, essentially is when either an exchange or a market participant basically trades on both sides of the book with zero commission, just to induce additional volumes, either to push price in one direction or another, or simply to induce fake volumes onto a trading platform. So I do think that, volume, I used to trade, when I traded FX, when I traded funds during the early 2000s, mid 2000s, I used volume indicators as a big piece of my own trading arsenal. And as Jason just described, when you see prices rising with lowering volume, that usually means that you're going to see a reversal. The same thing happens on the downside when you see prices falling as volumes start to become lower, and the same thing happens on the reverse, meaning that if volumes are increasing, it usually means that there's a buildup either on one side of the market. So I think it's hard for me to trust 100% the volume indicators, but even if it's 90% wash traded volume, it's still higher than it was in the previous days, which means there is an increase in volume. We're seeing an increase in volume and not really an increase in price. So we may be starting to see some distribution. So distribution of sellers at the current price point, waiting to push price lower.
Kevin, I want to stick with you because you've just said that you previously used to trade a little bit of FX. So Barry Silbert, the founder and CEO of Digital Currency Group, he recently said that he believes Bitcoin has won the race to be digital gold. Do you believe this, and his view that Bitcoin can also become a safe haven asset?
A bit of a statement. I would say no. Gold has, gold isn't the most stable of assets either, right? So in the 80s, gold traded upwards of $900 US. It fell down to under 300 in the early 2000s, and now we're back around 1,200. So we're not talking about the most stable of assets over time either, especially during small windows of time. It was quite a volatile asset, and either was very overvalued or very undervalued at different times in the last 20 to 30 years. But when you talk about Bitcoin, I would say no. I don't think Bitcoin has proven. Bitcoin is in the initial white paper talks about basically it's a payment. It's used for payments. That was the idea, right? And it hasn't quite yet proven that use case. And then a lot of Bitcoin proponents talked about being store of value. Not really. You can't really have a store of value that is as volatile as Bitcoin has been over the last, let's say, 18 months. Right now, it's not as volatile as it was, even 2-3 months ago. So I guess if you want to make that case in the last 2 weeks, I guess it looks more and more like a store of value. But I don't think it's actually proven that point yet. I think it could. And, it does hold the vast majority of liquidity in the market, which means as bigger players come in, if they want to start getting their feet wet in crypto, they're going to go to Bitcoin. They're not going to go to other assets because liquidity sits with Bitcoin. So in that aspect, I would say it is kind of like the safe haven, so to speak. But I wouldn't make a comparison to gold. I think gold worldwide has always been an underpin for turmoil. So when there is turmoil in the markets, lots of people run to gold. I don't see lots of people running to Bitcoin right now when there's turmoil in other parts of the world. So I think it's probably maybe in the future, but right now I wouldn't make that comparison.
And Jason, what do you think? Do you think Bitcoin has won the race to become digital gold? What do you think?
Yeah, I agree with Kevin on this. Basically, I think Bitcoin is clearly a lot more volatile than it needs to be before it becomes a decent store of value. I mean, and that comes down to the core belief about what Bitcoin actually is, whether it's a currency or a store of value. And as long as it's sort of going up or at least staying stable, it's a good store of value. But lately, it's been so. I mean, even over the past few months, anyways, it's been much too volatile in order to be a really good store of value. But on the other hand, over time, it could well become that store of value. Particularly like once 2019. Once we're in mid half of 2019 and the infrastructure for Bitcoin becoming more of an institutional investment starts coming into place, we might see less volatility after it pushes up to a certain point, and at that point it might start looking at like a more attractive store of value, but clearly not could not be compared to gold by any long shot. But one of the points that Silbert made is that younger investors don't quite hold gold with the same hallowed view that their parents did, and that $30 trillion in baby boomer wealth is due to be passed over the next 2 decades, and a lot of that, or at least a proportion of that, may end up finding its way into Bitcoin. So even if a small, tiny portion of that ends up as Bitcoin, that could be obviously huge for Bitcoin or huge for the market, but also make it more of a bit closer to a safe haven asset, but clearly nothing close to gold.
And Jason, I'd like to stick with you because you mentioned there briefly institutional investors. Now, we spoke about this yesterday with Kevin. Maybe we can get your opinion on this as well. So Anthony Pompliano's Morgan Creek firm has become the first crypto firm to bring pension funds to the digital asset industry. How important do you think this is for the cryptocurrency market?
Well, I think it's enormously important, only because it signals sort of like the starting gun for institutional investors to get in. I mean, keep in mind, first of all, Morgan Creek Digital has made some excellent investments. I mean, these are the people that have invested in firms like Bakkt, Harbor, Coinbase. They really know what they're doing, especially, of course, Anthony Pompliano. He's been a crypto bull for a while. He runs his own crypto show. And, so he's really bullish on crypto. And one of the main things that he pointed out is that their original target was to raise $25 million, but the deal was oversubscribed by institutional investors, and that's how they ended up with $40 million. And if you consider the fact that that's anchored by 2 public pensions, several institutions, including a university endowment, a hospital system, an insurance company, and private foundations, that really starts to show a major buy-in from very, very traditional investors. And I mean, one of them, if you think about it, is the Fairfax County Police Officers Retirement System, which you'd never think of traditionally investing in crypto. And these 2 separate pension funds that actually put in money into this fund, into Morgan Creek's fund, was actually manage a total of $5.1 billion in assets for state police force and other employees. So you could see how very easily how that can increase from 40 to 80, and of course bringing in interest from other players that might get into this game again as well. So I mean, I think it's enormously interesting, and I think it's a huge signal, like a starting gun, that institutional investors are hungry for this sort of asset.
Fantastic. And Kevin, I'd like to turn our attention to you, because Pompliano obviously does speak of institutional money already in the crypto market. Where exactly is it, and how is it affecting the market at present?
I think Jason just touched on a bit of that in his last answer, but I think most money that's being pumped right now from an institutional set is coming into infrastructure. So I think these guys generally see the writing on the wall. So they understand that more than likely for them, the difference between the institutional players and, let's say, the retail guys are really the end game, I think. The institutional, I think, see the end game as probably the use of tokenization inside of markets that they have been dealing with for years. So I don't think they see as much, let's say, potential, let's say, in the current state of the market, but they look towards the future. So lots of their investments, lots of that money is going into infrastructure, meaning things like exchanges like Backed that Jason just mentioned, like large-scale projects that deal not only in finance but also in logistics and maybe in other something like even the JPM coin that we talked about earlier in the show, and different larger scale let's say larger scale builds that are looking to take on problems that exist in markets where blockchain or some type of crypto asset can actually help. Though obviously there is money, talk about pension funds. I mean, pension funds like to take high risk. They always have a portion of their portfolio in high risk, especially for money that flows in from younger aged individuals inside of those pension funds. So over the years, that has been bonds. It has been sometimes into even junk bonds. Back in the 80s, pension funds had lots of money in the junk bond market. So they always have an appetite for high risk, and right now one of the most talked about high risk investments is into the crypto space. So it doesn't really. I think there's definitely institutional money that flows in, but I think most of the real capital right now, because there isn't much for them to buy in terms of actual products, right? So there's not that much liquidity available. It's difficult to acquire the liquidity. We're talking about a very, again, segmented market between dark pools, or what, again, the misnomer that lots of people use is OTC. The whole market is OTC. But when we talk about larger deals between 2 or 3 players where they fix pricing, all these things, obviously there are institutional funds that flow in and out of these type of products and create liquidity pools for smaller firms to be able to pull liquidity from, like exchanges, for example. But I think most of the money right now that's flowing in is definitely flowing more into infrastructure than anything else.
And yesterday when we spoke about pension funds, Kevin, you said likely that people are just dipping their toes in at the moment. Is it safe to assume that more pension funds will look at investing into crypto as time does go on?
Like I said, they always have an appetite for higher risk investments. So as long as crypto, the one funny thing there, I guess, is that as crypto matures and becomes less of a risky investment, the appetite for certain pension funds will probably decrease. However, the appetite for other large-scale funds will probably increase. So it kind of depends on where the market goes from now. But yes, they're dipping their toes in. A lot of people were waiting on, saying, at least in the U.S., once there's a qualified custodian, this is going to blow up. And that happened already, and we haven't seen all that much of movement. A lot of it's because, of all this talk about a bear market. I think for some reason, even smart investors somehow correlate price to the actual well-being of the market, which is kind of ridiculous, because a normal investor won't do that to any other market. If the price of corn falls down, you're not going to see a bunch of agricultural, investors start to pull their money out of agricultural stocks and infrastructure funds just because corn prices fall or cattle prices fall. But for some reason, with crypto, I think because people see it as a different asset class, even though it's really just a different type of representation of asset classes we've had for many years. People have this thing that because the price point is lower, somehow the market is not as, let's say, not as apt for investment. And I think that's going to change over time. But we definitely are seeing people getting their feet wet. I think they need to get their feet wet. They need to understand that what this market is. As the market starts to increase, as the market cap starts to increase, when we see this next retail bubble come in, I think we're going to see an acceleration of not just pension funds, but other institutional vehicles as well coming into crypto.
Great. And Jason, I'd like to turn our attention to you now, because Reality Shares tried to sneak a Bitcoin ETF past the SEC. The Commission immediately asked the firm to withdraw the application. There's little information out there. Can you help us explain what happened and how this will play out for the market and the future of ETFs?
Sure. Reality Shares proposal essentially outlined an ETF that was composed of both allocations in CMEs and CBOEs, the Bitcoin futures from both firms, and other monetary instruments like sovereign debt products, like the British pound, the Japanese yen, Swiss francs, and other government-issued cryptocurrencies. And I guess the logic that they had was that, well, maybe the SEC doesn't want to approve a fully-blown crypto ETF, but at least this limits exposure to 15%. But of course, that didn't quite pass muster with the SEC, and they were asked to withdraw. But I think the main reason, at least that they gave for the withdrawal, was that SEC staff were taking the position that it's not appropriate to file a registered 40 Act fund with cryptocurrency exposure. And essentially because filed under that Investment Company Act of 1940, it would have allowed the ETC to see automatic approval in 75 days, which I guess they didn't feel was appropriate. But overall, I think cryptocurrencies are in their most viable state ever, and ETF tracking of these assets is basically an inevitability. So I mean, even we've seen this even from SEC commissioners that have expressed, the SEC commissioners that have given sort of an inside perspective, including Robert J. Jackson and Hester Pierce, Crypto Mom. They've basically signaled that ETFs are an eventuality.
Great. And now, Kevin, just quickly, so we've talked about JP Morgan. We've also touched on reality shares. Just hours ago, Domino's Pizza has announced it now accepts Bitcoin as payments for pizzas. How will this impact the cryptocurrency sphere?
Well, the mature investor inside me says it won't affect at all, really. I think I think Domino's Pizza is a little late to the game for the kind of we accept crypto hype bubble. But it seems that they're trying to get a small little piece of it, at least with this announcement. I don't think it's bad, but in reality, again, and Jason and I both touched on this kind of what is Bitcoin? Is it a payment? Is it a payment infrastructure, or is it some type of store of value, or what exactly is the true meaning of Bitcoin? And obviously here, this is a push to say that it is made for payments. I don't think anybody that buys from Domino's, I don't think they're going to gain new clients because they accept Bitcoin. And I don't think, generally speaking, people are going to, they're now, I couldn't buy pizza before because I don't have a debit card or cash or a credit card or whatever, but I have Bitcoin. But I think
And it looks like we're having some connection difficulties with Kevin there. If we've still got Jason on the line, if we've got... Nope. So before we sign off, I do have a last-minute update from our editorial staff regarding the crypto market. While stability is a good word to describe the most recent market movements, however, the total market capitalization dipped below the $120 billion level. The 24-hour traded volume is showing no significant change, as it stayed above the $20 billion mark. The top digital assets are still trading in the red. Litecoin and EOS are the top decliners among the major assets. Both of them have a market capitalization of slightly more than $2.5 billion. So the battle for the fourth position continues. Well, that's all for this Thursday's Crypto Now live show. We thank Kevin Mirko and Jason Fernandes for their expert analysis. And we thank you, the audience, for joining us, and invite you all to accompany us every weekday at the same time.